Afternoon all. It looks like we've got quite a few people logged on now, so I'll kick off anyway. Thank you for attending our webinar here today on funding for the future and specifically the recovery loan scheme. Today we're going to be covering quite a few different items, generally where we are on the lending market and what we're looking at going forward for the next 12 to 18 months. I'm pleased to say we've got Kaylee Graham from Capitalise joining me today, who's going to be going through all the content, and I'll be offering my opinion where relevant. It'll be a really interesting webinar because we've had quite a turbulent last 18 to 24 months with COVID in the lending market, and as we're now starting to come out of that, it's a really interesting time for us and clients alike to see where the lending market's going, what it's shaping up as for the next 12 to 18 months, and what we can do to help our clients. So just to kick off with things, a little bit about us in terms of Raffingers. I'm sure many of you on today are clients of ours or know a little bit about us. We're an accountancy practice, and as much as we enjoy providing the core services with regards to accountancy and tax and compliance, we always try to go further for our clients. So we always try to get involved in different things, whether it's trying to make sure that we've picked up on things with regards to Capitalise and lending bits, but also any advisory pieces. As you can see on screen, we've got our key values, our core values that we have as a business that we like to go through, and we're really proud of these. These are things that myself and the other partners and all staff really focus on and adhere to. So for us, it's about sticking to these core values in all services that we provide to our clients. Okay, you can click on to the next slide. In terms of the services, like I said, that we offer, the services aren't just limited to compliance, and it's really interesting. I always say this to new clients and new staff that we take on. You know, as an accountancy practice, people think that we're pretty boring and we only do tax, compliance, and accounts. But where we enjoy our work most is providing the added value services, and you can see we've got a few things on there. So whether it's the strategy work that we do with clients, cash flow improvement using profit first, which is really interesting. A lot of our clients are getting involved in the wealth management and corporate finance side of things. So looking at established businesses and owner managed businesses as exit strategies. And then as usual, as you would expect, the tax planning, forecasting and management side of things, that's really important to us to give us an added value to our clients. And something that we've really picked up on recently, and especially with our online businesses, you know, the guys in that sort of digital and media space, is the systems integration and organizational management. Those guys are really looking at systems and how they can look to change their businesses to ensure that they're developing themselves for the future, whether it's through Xero or whether it's through other apps that they're using. So as you can see, as an accountancy practice, we're not just accountants. We add a lot more value to our clients. In terms of the webinar today, so like I said, we've got myself and Kaylee on. I've been with the practice probably now for about 5 years, so I'm also one of the partners here at Raffingers. You know, I get involved in pretty much anything and everything. So whether it's looking after owner-managed businesses and getting involved with the compliance, but also sitting with my clients and trying to understand their businesses and help them grow for the future. I'll pass it over to Kaylee now, and she'll tell you a little bit about her role at Capitalise.
Amazing, thank you, and thank you for having me. So as Michael said, my name is Kaylee Graham, and I am one of the partnership managers here at Capitalise. Now, essentially, Capitalise is a business that works with accounting practices up and down the country to support them, to help clients just like yourselves, to make sure that actually they are getting access to the right funding at the right time, at the right price, and from the right people. And we'll go through and kind of talk about what that looks like. But in short, my job is very much to make sure that all of you know what's available and how you can access it with the support of Raffingers and the team.
Perfect. Thanks, Kaylee. So in terms of today, like I said, we're going to be talking primarily about the recovery loan scheme. And you know, when me and Kaylee were prepping for this and having our discussions as we do with Capitalise, one of the things that we spoke about was how the lending market has changed massively. And that's the biggest change that I've seen, especially for our clients and people that we're speaking to. You know, literally each quarter, or you know, when we speak to Capitalise, things are changing all the time. Parameters, lending requirements, products, everything's ever evolving. And as much as you know, it's great for clients, it's also quite a difficult process to try and keep on top of everything. So what I'm hoping today is just going to give you guys a real good summary of where we are in terms of of the market, for the recovery loan scheme, but then also general COVID lending that we've seen and all the government support that we've seen through the last 18 to 24 months, and what we think is going to happen for the next 18 to 24 months. I think that's really important as part of this recovery loan scheme. Every client I'm speaking to at the moment, we're sitting down and having these conversations saying, what are your plans? How are you going to look to finance that? Do you need to go down the lending route? Do you need to consolidate your existing debt? And these are the conversations that I feel everyone should be having, because the market is so dynamic and it's ever changing. So in terms of the agenda today, we're going to be looking at, like I said, the funding post-pandemic, the recovery loan scheme features, which are quite interesting. There's a lot of stuff that I didn't necessarily know about until I looked into it. And why would you choose a recovery loan scheme? That's a common question that I'm getting asked by clients all the time. A lot of guys have taken out the bounce back loans, C-bills, and they're now looking at this and saying, actually, I'm quite leveraged already. I've actually got quite a lot of debt. Why should I look to go for the recovery loan scheme? So we'll cover that off. And then also just a little bit of a pickup on the traditional commercial lending. Where are we in this market? What's been going on in addition to the RLS that we have, which is out there at the moment? And at the end, of course, we'll invite any questions. And I'm really keen to hear, if you guys do have any burning questions or do want to ask us anything specific, we can really pick up on that.
Amazing. Thank you very much. Perfect. So funding post-pandemic. I think, as Mehul said, we definitely can't ignore elephant in the room, right? It's been a turbulent time. But I wanted to start kind of with borrowing as a whole and actually the impact that that's had. So typically what we see in the lending space is that large businesses, big corporates are very used to leveraging their balance sheet, taking on debt and using that to fund growth, fund acquisitions, whatever that might be. What we've typically seen is that actually our SMEs in the UK and general business market is that debt is still seen as a little bit of a bad thing a lot of the time. It's seen in the consumer sense of the word, and so people don't rush to take it, right? It's very much if I really need it, I'll think about it and I might go down that route, but if we can fund it another way, we will. If we can fund it out of cash reserves, if we can fund it personally, that's what we'll look to do. And so that was reflected very much in the borrowing that we saw through the pandemic. So what this graph illustrates is that big black line is the corporates. And actually, if you look at around kind of March, April time 2020, there was this real spike. As soon as pandemic hit, big businesses in the UK went and took up funding. They went and got themselves geared up and ready to get through that tough time. We didn't know how long it was going to last, and I don't think anyone thought it would last as long as it did. But actually, as soon as they got wind of that, they got the money in the bank accounts, and they made sure that they were kind of strapped up and ready to go. What we see with the SME space is that actually we don't hit that peak of borrowing until around March 2021, which was right when kind of bounce back loans and C-bills were coming to an end. And so I think that just really reflects what we kind of expect in terms of behaviours. But what's really interesting is that actually after kind of April this year, we go back to that black line, and since then large businesses have been borrowing again. And what we're seeing reflected in the SME space is that is continuing to decline. Now, part of what this conversation is about is really challenging those behaviours, right? And saying that actually what we need to be doing is encouraging the forward-thinking behaviour and the kind of preparedness that we see in the large businesses and filtering that down through the rest of the economy, right? So if big businesses are borrowing again and they're getting themselves geared up and ready for whatever 2022 onwards may face, that's exactly the position we want all of you guys to be in, right? And that's why we're talking about the recovery loan scheme now and not maybe in 6-12 months time when you're going to be really strapped for cash. It's about, let's get it in now while the business is doing well, while business is strong and can support that debt. Let's get it in and make sure that you know what's available. So by all means, this is not about getting people to take debt that they don't need, that they don't want. It's just about getting that kind of mindset shift into, okay, what are our plans for the business for the next 12, 18, 24 months? What kind of capital do we need to get through that, and how do we leverage ourselves and get ourselves ready for that? Perfect. So, sorry, Mehul, go ahead.
Sorry, Kay, just to pick up on that last slide, and this is something that we were discussing previously. What was really interesting for me and Kaylee when we were looking at this data was, if you look at the lag between small and large businesses, like Kaylee specifically mentioned, is you'll see from April 21 onwards, large business lending has picked up again, which was interesting as the economy started to open up, as lockdown ended. And the prediction that everyone kind of sees at the moment is not just with the recovery loan scheme, but with a lot of the smaller business lending, the SMEs, that we have that grey line at the top there, it took a dip at the same time large business lending picked up. And if you were to extrapolate that graph out, and as in when we get that data post July 21 onwards, what you'll tend to see is that SME lending will increase, not necessarily just driven by the RLS scheme, but it's going to be where businesses are consolidating their debt, or as they expand and as they grow through the economic growth that we have post-COVID, now lockdown has ended, those businesses are going to have an appetite to lend, to really expand and effectively scale up. So it's really important to understand where the market is going based on what we can see historically. And my sort of prediction to it, and again, I could be wrong here, is that we'll see a real increase in the SME landscape for lending, not necessarily just through the RLS scheme, as people look to take advantage of the low interest rates that we have for the moment. And then at the same time, as they look to scale up their businesses, you're going to see a real increase on the SME side.
Absolutely, absolutely, and we're already beginning to see that on our side, right? And so I completely agree that will be what we continue to see, and as you say, as that data kind of comes out and we start to see it trending, I think you'll be exactly right on that. So thinking about kind of the products that the pandemic brought in, actually pre-COVID, we had grants kind of generally out there in the market, and we had what we call kind of standard commercial lending as normal. We hit March 2020, and actually we're in this crisis, and we see a whole host of new things come into the market to try and support businesses. We had grants coming in, we had ETAB to help out, we had VAT, stamp duty, grants, debt freezes, everything, you name it, it all came through, right? We had furlough. There was a moratorium on insolvency, there was income support, there was CBILS, there was bounce back, there was still some commercial lending going on in the background as well. So it was a kind of whole host of various things coming in, and lots of support for businesses. And I think there's varying opinions on how great that support was, right? And whether it did enough. But the reality is there was a lot going on out in that space. And so what's been really interesting is that all of those things have now kind of come to an end. Right, we saw insolvency moratorium lift at the end of October, that we've seen furlough go, and so actually all of these things are now coming back into the market just as businesses are opening up and they're finding their feet again. But what that's resulting in is more costs again, right? Actually, okay, you're having to pay staff again. Actually, the insolvency moratorium's gone, and so businesses are now able to push each other into insolvency again. And so actually you need to be sure that you are paying people on time, that you're getting that money out the door when it needs to, but also that you are collecting on that, right? And so what we've definitely seen is that kind of squeeze on cash flow. We saw the VAT rise come back in, and so people are feeling that pinch. And actually, there are some businesses out there that have thrived through COVID, right? And they're in a brilliant position, and these things haven't really affected them. They're like, it's fine, we're prepared, and we're good to go. But the reality is, there is a huge percentage of businesses that still need support. And the issue with that is that if we look at pre-COVID times, you had 5.9 million UK businesses and 365 lenders out in the market. The reality of what businesses were doing to access finance was either calling their bank if they had the kind of luxury of a bank manager, or going on Google, typing in business loan and kind of hitting the first 5 results, right? Which the reality of that is they are the first 5 that have paid the most to be at the top of Google, as opposed to the top 5 that are most suited for your business, right? And that's just the reality of that lending market pre-COVID. Going into COVID, again, pretty similar, right? People were used to picking up their phone to banks and they were filling in online forms and getting bounce backs, or they were doing that with CBILS. And now that those have kind of gone, we're in a bit of a strange space where businesses are starting to try and revert to old behaviors of, okay, I need funding, let's do the Google search, let's go and try and do it ourselves. But actually the lending market isn't the same. You've got 365 lenders technically still out in the market. We've lost a couple through COVID, but predominantly roughly around the same number. But actually what's interesting about that space now is that we've got the recovery loan scheme in the mix, but there's only a certain amount of those that are actually accredited to provide that. And unlike with CBILS and bounce back that we saw, where banks were kind of pushing their money out the door and they were there to support, actually they don't want to lend under the recovery loan scheme. I speak to bank managers across the country from various different tier 1 high street banks, and the reality is it's not something they're looking to do. And there's various reasons behind that I'm happy to touch on later, but the reality is it's not what they want to do. And so you've got this small pool of lenders, a huge pool of clients, and actually they're all trying to kind of shoehorn themselves into that. And this is really where the importance of having great conversations with Mehul and the team, with ourselves, is about making sure that we're fully understanding the needs of the business so that we can then tailor what support you need moving out of that. Because yes, there's commercial lending, yes, there's a recovery loan scheme, but what's right for your business and what kind of support you need will vary. And so that conversation is completely crucial. So thinking about life cycle of a business, actually you're all going to be at varying points of this, right? A business comes in, you're a startup, you move through that to grow, we get into a point of maturity, and at some point you'll exit, right? Be that through sale, be that through actually just winding things down, whatever your exit plan is, at some point you will exit. And actually, on average in the UK, a business lifetime is about 8.5 years. There are obviously businesses that are around for hundreds of years, and there are some that come and go in a matter of months, right? And so it very much is an average. But the way that we like to look at that is that we think, okay, if Mehul and the team took you on day one as a kind of startup, actually roughly they've got 8.5 years to help you get to a point where you can have the best exit possible, right? So you can sell for the most money and retire on a yacht, or actually just wind things down and go back to whatever it is that you wanted to do after that. But the reality of it is, at every point in this journey, there is going to be a need for capital. That might be a need for external capital to help you get going. That might be the need for external capital to help you expedite the growth so that you can hit that maturity point and exit sooner, right? Whatever that is, actually at some point there is going to be that need for capital. And again, it comes right back to the point I made at the start around challenging this mindset that debt is a bad thing, and actually starting to see debt as a force for good, because ultimately it's exactly what's going to get the country back up on its feet. Pre-COVID, for every £1 of money that was lent into businesses, £3 went back into the economy. And so actually, as we say at Capitalise, it very much is a force for good. Mehul, I know you've got a few thoughts on this bit in particular.
Yeah, it's really interesting. When we were talking about this, Katie, I didn't really appreciate the number of new SMEs in 2020. Everyone has such a negative view on 2020 due to COVID and everything that happened, and to have 726,000 businesses that have launched in 2020 is, for me, is unbelievable. And I link this back to the first slide when we looked at that lag in lending, and how what we've seen is a dip in SME lending towards the end of 2020 going into 21. And due to a lot of these new businesses, what you're going to see is after about, and this is based on my experience when I take up a startup business as a client, after a year or two is when they really start to have the conversations with us to say, actually, we want to look at some lending. And that's where we're getting to as we go into 2022. A lot of these businesses that launched in 2020 are going to look at us and say, actually, we've done pretty okay. We've launched a new business. And as Katie said, there are some businesses that have thrived through COVID. And as we come into 2022, I'm looking at this and thinking, hold on, these guys are going to need some sort of lending to either scale up or to look at how they're going to operate their business going forward. Like Katie says, debt is not necessarily a bad thing. And what's really interesting for me at the moment is with the recovery loan scheme, you need 2 years worth of trading accounts. And Katie will come onto this later in the webinar in terms of features. And that chimes really well with the number of new businesses that have launched in 2020. And even with looking at scaling up, it really times well with regards to looking at getting through that first 2 years, coming into 2022, taking advantage of the recovery loan scheme, or looking at more commercial lending to consolidate your debt. I just think it's such an interesting and unique time in the market where all these different factors are playing into it, and it can really make a big impact on your business effectively to try and scale up.
Absolutely that. So recovery loan scheme, we've touched on it a few times, but just to kind of give a little bit more detail, actually, I was meant to have a nice little bit on this slide that would like cross out that first line, but I completely forgot, so forgive me. The recovery loan scheme was available until the 31st of December 2021. They have now extended that into the new year. Now, that said, there's an interesting point on that I'll come back to, but it's available now up until, I want to say June, end of June next year. So there is still time to get access to that. You haven't run out of time by any means, and we can absolutely still have those conversations. Now, in terms of what you can borrow, actually between £25,000, well, 25 and £1, and 10 million per business in the form of a term loan or an overdraft. Alternatively, between 1,000 and 10 million in the form of invoice finance or asset finance. Now, actually, in terms of other bits to note, there's no turnover limit on that. So previously that was 45 million. There's unfortunately no secured product. So with the CBIL scheme, you could actually borrow against property and you have that as security. Actually, this time around, they've removed that. And the only other caveat is that you have to have been impacted by COVID. I caveat that caveat with the fact that impacted by COVID is a very broad term. And actually, we're seeing a wide range of applications, right? In the sense that we've seen some businesses who have obviously had a massive downturn. They've been really negatively affected, and that's their impact of COVID. We've seen another business who actually has done really well and is super profitable, but they're impacted by COVID is that they completely pivoted their business model and took on a whole new service line and launched that. And so actually the funding that they're getting is to continue expanding that. Now, arguably not negatively impacted at all, right? But they were impacted and it's taken a new spin on their business, and so it's something that they need funding for. So don't be put off by that kind of piece in there, because ultimately everyone's been affected in different ways, is what I would say. Now, as for scheme being available up until 31st of December, it kind of moves into this piece, right? So actually, whereas with bounce back loan and CBILS, you applied for a bounce back loan or you applied for CBILS and you were assessed on that basis and you were given a yes or no on that basis. With the recovery loan scheme, that's not the case. Ultimately, the scheme is choosing which businesses it wants to support. So for instance, if we took an application for your business to a lender, we might say this business wants a recovery loan. Actually, they will assess it, and it may well be that they deem that the business isn't fit for a recovery loan, and they will offer a normal commercial loan instead. And so there's a definite choosing in there that happens where we don't have quite as much control as we did with bounce back loans and CBILS. All lenders had to be reaccredited post CBILS, so you would have thought that the lenders that were accredited for that scheme would have kind of just been able to carry on. Actually, that wasn't the case. They had to go through a whole new reaccreditation process, which is what I was talking about before around having 365 lenders in the market, but actually only a handful that can offer the scheme. And it's been a really lengthy process for them, right? Scheme went live in March, and actually we've had lenders just recently getting accredited and coming onto the scheme. And so that's part of the reason that they extended it, is because actually businesses that maybe applied in March time and were declined, there are now more lenders on board, and so they've had to extend that scheme. Now, in terms of kind of government guarantees, actually, as with bounce back loans and CBILS, there is a government guarantee in place for the lenders. It's very much not for the business, it's completely for the lenders, and actually it's up to 80% of the value of the facility that they provide. Now, that is only until the 1st of January 2022. As of the 1st of January, that government guarantee reduces to 70%. And this is what's quite interesting here, is that in theory should have no impact on the business, because the guarantee is for the lender and not for the business. However, what we are expecting to see happen is that actually, because the lenders are going to have a reduced guarantee for the government, they are going to be slightly more risk averse. So they are probably going to narrow their criteria slightly more and be more risk averse. And naturally what will happen with that is that pricing will probably go up. And so despite the fact we've got this extension, actually what we're predicting is that the scheme will have a slight sting in its tail and a slight change as of the 1st of January, because lenders are going to be subject to this new level of backing by the government. So whilst it is extended, you've got more time, we are still very much pushing the messaging of, if this is something you're interested in, let's think about it now, let's get the applications in now and make sure that you are getting the most competitive pricing, etc. out there that we can. So 70 lenders under the scheme, and actually what's really interesting is there's been no real stats released on the recovery loan scheme. We saw HMRC put out a very brief, it's about 4 sentences long, kind of statement about the success of the recovery loan scheme so far, and not much else. And that is, we think, reflective of that kind of lag that we see between big businesses and the smaller SMEs out there. So no real stats, but what we are determined to do, and what the team at Raffingers are determined to do, is make sure that essentially every client is aware of their options, what's available to them, so that actually when those stats do come out, even if those numbers are low, we know that we've gone out and we've supported all the businesses that we can. Perfect. So other features of the RLS, personal guarantees, always an important thing to touch on. So I think there's definitely misconceptions in the market about what exactly a personal guarantee is. But I like to think of a personal guarantee essentially as a promise between the directors of a business and the lender to say, do you know what? We fully believe in this business and we think we're going to be able to repay this money. But if for some reason the business cannot, we take responsibility for that and we will make sure that that debt is paid back to you. It is not a charge on your property. It is not a charge over the machinery in your factory or anything like that. It is essentially some documentation between you personally and the lender to say that, yes, this is something you will do. Now, what's really great about the recovery loan scheme is that actually up to £250,000, there is no personal guarantee. And so you're not having to sign that. Ultimately, the lender is taking the risk because there's that backing by the government. And so they're not asking for that. And actually over £250,000, any personal guarantee that you do give would be limited to 20% of the facility. So still a greatly reduced risk. One other thing I like to note on personal guarantees is that £250,000 limit is per lender. So if, for instance, you are a business that is able to borrow £1 million under the recovery loan scheme, it might be that actually you borrow that million spread across 4 lenders, for instance, at £250,000 each, and actually you wouldn't have to provide a personal guarantee at all. If you were to take that with one lender, then yes, there would be a 20% guarantee for you to sign, but actually spread out and across those, you don't have to give that. And so it's definitely, again, something worth looking at. We think that once this scheme ends, it's going to be extremely unlikely that there will be lenders in the market that will offer facilities on a completely unsecured basis with no personal guarantees. Pre-COVID, there were only 2 lenders that would do it, and it was for growth funding and acquisition, and you had to be a very strong business to prove that you could support debt with no personal guarantees or security attached to it. So it's definitely a niche situation and not something we're expecting to see post pandemic for sure. Perfect. So amounts and kind of terms that you can borrow. So generally speaking, a maximum of 25% of 2019 turnover. So same kind of criteria that we saw with bounce back loans and CBILS. Well, CBILS around the 25% of turnover piece in particular. So actually, if you took a coronavirus business interruption loan, so a CBIL, actually that is taken into account. So it would be 25% minus whatever you took as a CBIL, but actually your bounce back loan isn't taken into consideration. So if you were to borrow, say 25% of your turnover was £250,000, actually if you had a £50,000 bounce back, that wouldn't impact that and you would still be eligible for £250,000. If 25% of turnover was £250,000 and you took a £50,000 CBIL, that would be taken into account and you would therefore only be eligible for £200,000 as an example. So that's kind of how that's working. And actually, they're basing it on 2019 turnover because generally that's pre-pandemic and that's obviously when business in theory was doing best. That said, you can take into account 2021 figures if they show an improvement. So if you are one of those businesses that has actually seen an uptick in business, is doing well, business is looking better, they can absolutely take those figures into account. In terms of term, it's up to 6 years for term loan and asset finance facilities. But what's really interesting in that is that there's also interest-only facilities. So there are 2 lenders in particular that are offering 6-month or 12-month interest-only periods. So again, if you are a business that potentially is struggling to meet repayments on CBILS that you might have taken or bounce back loans or anything else at the moment, an interest-only facility could be a great way of easing that pressure on cash flow, because instead of needing to make that quite hefty capital and interest repayment, you're just going to be paying the interest for the next 6 to 12 months, allow you to get back on your feet, have that capital available to then start meeting those repayments. So great idea in there. And I've definitely seen a few where they took a CBIL on like a 3-year term and we're terming that back out over 6 years with an interest-free period for them. And no early repayment charges, right? And so this, I think, is a point that sells itself. If you are thinking that potentially in the next 12, 18 months, you might need capital to do something, and you can take that funding and you can do whatever it is that you need to do with it, or have it there as a safety blanket and then choose to pay it back, you are not going to be penalized for that. There are no early repayment charges at all on these facilities. So you absolutely can have it there as a cushion, as a fallback blanket, and then get rid of it. Or alternatively, actually, if you're going to take it on for growth, you bring it in, you do what you need to do, that growth is exponential, and suddenly you've got the capital to repay it, you can do that, right? And so this is by no means trying to trap people into debt or extremely long facilities. You can get out of jail free at any point, essentially, on that. Perfect. So in terms of fees and rates, maximum APR on the recovery loan scheme is 14.99%. Now, typically what we're seeing is actually between the 8 and 9% range, which is nice because it's definitely below that threshold. But what I always like to caveat is that pre-pandemic in an unsecured loan, so that would be a facility of say up to £350,000 with a personal guarantee, we would see rates anywhere between 6 and 26%. And so I think some are definitely still a little bit shocked by that 14.99, but actually in comparison with the removal of personal guarantee, that is not a bad rate, right? And as I say, averagely we're seeing between 8 and 9, which again is a very respectable rate. I think typically we are used to seeing high street bank rates, right, which are anywhere from 1% to 4%, and we get comfortable in that space and we think that's a good rate, and it absolutely is a good rate. But it's all relative, right? Actually, if you're buying a property that's worth £1 million and you're taking £100,000 worth of finance against it, you'd be crazy if you took anything over like 4%, right? Because it's a fully secured loan, they've got no reason to, and so you would expect that really, really low rate. Actually, as I say, it's about risk here. These are generally, business space is a space that has been greatly affected by pandemic. These are businesses that are recovering, businesses that are trying to grow again, trying to find their feet, and there is an inherent risk there. And so as a lender, they have to factor that in. They have to factor in things like sector and understanding how the rest of the businesses in that space is done. They have to think about the future and what happens if there's another lockdown, what happens if, essentially. And so those rates are reflective of that. But actually, as I say, typically between 8 and 9% is not a bad rate in comparison to what we've seen previously. Inclusive of fees, so those rates are inclusive of any fees that are part of that, which typically drive rates up, but actually that's included, and fees to be paid by the business. So with the coronavirus, actually government was paying interest for a period and they were paying the arrangement fees. That is no longer the case. So any arrangement fees on facilities would need to be paid by you as the business. That said, typically arrangement fees are between 1% and 3%. So there is a fee, but they generally tie that into the facility as well. So you wouldn't be expected to pay up front. It kind of just gets added onto the loan and spread out across your repayments. So lenders are trying to make that as kind of manageable as possible as well. But ultimately they are businesses too, and also looking to make some money. Perfect. So recovery loan opportunities, this just touches on that pricing piece again, because I do think it's important to kind of hammer home what that looks like. So for instance, if you took a £50,000 bounce back loan, that was coming in at 2.5% a year, which was very favourable and nice. Actually, if you took a £50,000 recovery loan scheme facility as well at 14.99%, which is top end of that barrier, right? Actually, at a blended rate, you're coming in at 8.745%, which, as I said, we're typically seeing between 8 and 11%. So you can imagine that blended rate would probably go down. And actually, you're in a quite competitive pricing space. Bank overdrafts typically between 5 and 30% per annum, credit cards between 25 and 40%. And actually a lot more unstable those facilities are. I don't know if anyone on the call has had a Barclaycard business facility, but actually go back about 12 months, they suddenly hiked their rates up because it's in their terms and conditions that they can do so, and they pretty much doubled the rates overnight. Actually, if you go and secure this facility locked in at that rate, and that's all you're ever going to pay on it. So I think it's, again, just bringing to life what that means in practice, because it's definitely easy to see the 14.99 and think, oh, that sounds a bit pricey. Perfect. So most importantly, eligibility criteria. So Mehul touched on it. We are generally needing to see 2 years of trading history. And that is just because lenders like averages, and you need at least 2 to take an average. And so that's typically what's going on there. They also need to be able to see credit data. If you're a new start business, chances are your credit score isn't great through no fault of your own. It's just the lack of data, right? And ultimately, that's the way the lending space is driven now. It's data, data, data. So the more they can get, the better. So 2 years trading history, maximum lend being 25% of 2019 turnover, as we touched on. And the alternative to that is 2 times your 2019 wage bill. So if your wage bill times 2 is higher than what your 25% of 2019 turnover was, it may be that you can go for that amount instead. Business needs to not be in difficulty, which in short means that you are not making a loss. Because ultimately, if you are a loss-making business, the lender's argument is if you've got no money left at the end of the year anyway, how are you going to afford to service new debt? In terms of documents needed, actually 6 months business bank statements, your 2019 accounts, most recent accounts if filed, directors and shareholders details, so names, addresses, wherever you lived for the last 3 years, all that good stuff, ID for directors as well, and then just the details of any existing borrowing you've got. So if you've got asset finance on computers or trucks or cars or whatever, you've got bounce back loans, you've got CBIL facilities, let's get a list of those just so that lenders know what they're working with. And it might be that actually they can encompass that in a refinance, right? So it's very much in your best interest to disclose that information. I caveat all of this with the fact that this is the eligibility criteria for the recovery loan scheme only. If there is something on this list that means you fall out of that criteria, it does not mean that you are not eligible for any funding ever. It might mean that, but we don't know that for sure until we explore the options, right? There are 70 lenders under the recovery loan scheme. There are 365 in the market as a whole. So just because you don't fit into this bucket, it doesn't mean that there is nothing available for you. It just means we need to have a more in-depth review of what's applicable and potentially go out to a wider pool of lenders to be able to get that support for you. So please don't be put off if you don't necessarily fall into this box. Thinking why RLS then? So it's a question, like Mehul said, right? People are asking why would I go for the RLS? But actually, one of the main reasons is that lenders have got allocated pots of money for this scheme. The lenders that are under this scheme that are wanting to lend have got pots of money sat there that they are waiting to hand out under this. And so by applying for it, if you fall into that category, there is money allotted for you, right? And so it makes sense to go and try and get your share of that pot. It can absolutely help with lowering repayments. If you are a business maybe that struggled and has taken on debt in a couple of different places, you might have taken a couple of CBILS from different places, you've got kind of existing finance elsewhere, or maybe you took on a bounce back loan and you've got some other bits and pieces that fell outside of government schemes. Actually, if we can consolidate all of that into one pot and turn that out over 6 years, actually what you might find is that your monthly repayments are significantly less. And again, if we take advantage of like an interest only period, they will be even less, right? And so it's really just about thinking slightly strategically around, okay, actually, we've got this debt and we can afford to pay it, but it's wiping out quite a huge chunk of cash for us each month. Is there a way that we can lower that gives us the cash available to do what we need to do to get back up on our feet, to kind of deliver on those plans for 2022? So that's definitely a driving force in there. New year expansion capital. I think people are still in the kind of dumps a little bit, thinking that businesses are really struggling, but some are and some aren't. Some are doing really, really well and they're super excited about next year and they want to expand and hire new people and buy new things. And this is a great scheme to do that under, right? Because it's cheap rates, there's no guarantees, you can take that money and kind of do with it as you will. So definitely worth thinking about if you've got plans for the next 12, 18, 24 months that you perhaps want to expedite, let's get that capital into the business so you can do it. Christmas expenditures, this is a standard one we see year in, year out, even without the recovery loan scheme. Businesses gear up for Christmas, right? More stock, more people, whatever it is, to be able to deliver the wonderful things that you guys do. Actually, if you need some additional cash to help support on that, again, let's go look for it. Lenders pulling out of the market. So I mentioned we've had a few lenders over the last 18 months pull out of the market in general. So we had Esme Loans, which was a subsidiary, there we go, I can't say that word, subsidiary of NatWest. They shut their doors, unfortunately, and said that they can no longer lend any money. We saw AIB are pulling out of the commercial lending market. And so if you are potentially a client of one of those lenders that you know is pulling out of that space, that has kind of served you that notice, said you need to look for a new facility, actually, again, this can be a great way of refinancing that for you. Refinancing CBILS, I touched on. We've had a few that were on shorter terms that we're just terming out to, again, ease cash flow. Brexit creates its own problems. I really thought we were done talking about Brexit, but it keeps popping up. But essentially, again, those additional costs and places in there, we can look at that. And job vacancies, right? Actually, highest in 20 years. If we are seeing kind of what we're seeing, particularly in like the accounting space, for instance, is that people are now paying over the odds for the same talent to go in and fill those roles because they just need people, they need bums on seats. And so actually, if you are also in that space and it's like actually your industry's been really hit by that and you are having to pay more than usual, it might be that that's an unexpected hit on cash flow and that actually you need to be able to bridge that gap to get people in. And again, we can fund that. I think common theme you'll hear through all of these, ultimately, if you need capital for insert whatever here, this is a brilliant opportunity to go look for it, right? It's got its own benefits. It's relatively cheap. It's relatively easy to access. Let's get in and do it now. Anything you want to add to that, Mehul?
Yeah, it's really interesting. I think where we're seeing it with our clients, just to sort of join up with what Kaylee's saying on this, in generally where our clients are going with the RLS, it was a slow uptake, like Kaylee says, from earlier this summer. We didn't see a lot of pickup, and it's more recent over the last few months. And as we go towards that December deadline, which of course has now been extended, but as you can see, as the rates potentially go up into the new year, where we're seeing a lot more action, I suppose, from our clients to actually, can I look at the RLS? And the reason for that is there's a few really. Firstly, around the refinancing, I think those guys that were on the short CBIL terms are now coming towards the end of that and are thinking, actually, you know what, can we refinance? Can we look at getting some more funding in? The blended rates is quite interesting. I think not enough business owners take a holistic view of lending and try and understand the blended rates that they can get with different forms of finance. So we're starting to see a lot of that. And then mostly around the expansion. Like Kelly says, there's a lot of businesses who've got vacancies who are growing. And this is just a really great scheme to try and get finance into the business to scale up. You know, there's a lot of other lending out there, like Kelly says, with other lenders. But for example, one of the reasons to go down this route would be without the personal guarantees. I think that's a really attractive proposition. And at the same time, even though the rates can potentially be as high as 14.99%, but we're typically from the examples that I've seen with some of my clients, they're not really necessarily getting near the upper end of those rates. So it's worth looking into if you are looking to get some finance into the business, getting some lending in, or you want to consolidate, or you want to expand. It's just worth exploring the option to understand what you can do with the RLS and try and see how it can work for you. And effectively, the way I see it, if I was a business owner, is do I really want to miss this opportunity of getting some lending in if I need it? And that's the key thing that I'm telling my clients all the time. If you are thinking of getting some lending in the next 12 months, really look at this scheme and try and go down that route. And if it works for you, great. If it doesn't, at least you know you've explored the opportunity and you can see what rates you can get and then take it from there.
Absolutely, 100%. So leaving recovery loan scheme for a moment and just thinking about lending outside of it, as I said, just because the scheme isn't right for you, it doesn't mean there isn't facilities for you. So thinking outside of that, actually property is a very big space at the moment. Development finance, bridging, commercial mortgages, buy-to-lets, you name it. Property is very big at the moment and lenders are loving it because with the RLS, they're getting no security, right? They're getting a government guarantee, but they have to fill in far too much paperwork to claim on it. And so actually, if they can get their hands on bricks and mortar security, that is ideal for them. And so what we're seeing is that actually in the commercial mortgage and buy-to-let space in particular, lenders are falling over themselves to offer really, really cheap rates, right? In the like 1 point something percent back bands, because they love that, right? They can get assets in, they know that it's there, they can get that money out still. So if you are doing anything in that space, if you are potentially renting your premises, you've got the opportunity to purchase it. If you are someone that's potentially been sitting on some cash and thinking about moving into the buy-to-let space and want to do some investments there, again, brilliant time to be thinking about that, and something that we can also support you with the help of the Raffingers team. Merchant cash advance. This is great if any of you are in the retail hospitality sector or kind of e-commerce space. Actually, what it is essentially it takes your card payments. So that can be in person or online, but actually whatever you're making through your card terminal on a monthly basis, it allows them to advance you kind of 1.5 to 2 times that amount. And then instead of having a fixed loan repayment like you would with the RLS, for instance, actually what happens is that every time someone spends money with you on their card, a percentage pays back your facility and a percentage goes back into your bank account. And typically that's done on a kind of 20-80 split. So you're still getting the bulk of that into your bank account. But it's great for those businesses that maybe don't have security to offer or aren't eligible for that recovery loan scheme. It can be a brilliant way of getting that kind of small cash injection in. And the real beauty of it, particularly in like the hospitality space, is that, for instance, if we go into another lockdown and you are suddenly closed and you're not taking any card payments, there's no repayment for you to meet, right? That gets frozen until you're taking card payments again. And so it's got real flexibility around that. Asset finance. Asset finance is an incredible thing and actually something I encourage everyone to look at. If you are thinking about buying anything that you can physically hold in your hand, it's worth having a conversation around asset finance, right? Because instead of you paying for all of that on day one, we can spread that cost out across 3 years, 5 years, whatever it is, to make that much more manageable in terms of cash flow. And actually, not my specialty, so I won't dive too much into it, but there's definitely a super deduction tax piece around this at the moment that you can take advantage of, which essentially allows you to kind of offset the cost of assets against profits and pay less tax. That sound about right, Mehul? Not an accountant.
Yeah, I was actually going to pick up on that as well, because the big thing that we're seeing at the moment on the general other lending side outside the RLS is specifically on property and asset finance. So on the property side, typically we're seeing property values as the highest we've ever seen them. And so at the same time, a lot of our big property clients are going out and doing a lot of development, a lot of acquisitions, and effectively that market is very buoyant with regards to the property side of things. So that's something to think about. But then even bigger than that at the moment is the asset side. And this super deduction, again, for those who have been following it, this is the extra percentage you get on your capital allowances that reduces your profits and effectively your taxable profits. So this is pretty much from 1st of April this year for 2 years. And this is a huge thing. I think, a lot of businesses must be looking at this and have to be looking at this. And I know a lot of our clients, it's the most common conversation I'm having with clients to say, actually, have you thought about getting some more assets into the business? If you need to in the next 2 or 3 years, do you need to renew your asset base? Do you need to expand your business and get some more assets in? Okay, you can get the super deduction, but at the same time, there's some really good competitive lending to finance those assets as well. So especially some of our bigger clients are really taking this on and actually planning out what they're going to be doing for the next 18 months or so now we've got left on the super deduction scheme, but looking at what they're going to be doing now and how they're going to be financing that. And it's a really interesting area. Now, I think at the moment, my gut feeling is that a lot of businesses aren't taking advantage of it as much as they should be. at the moment, the asset finance piece is still quite big, and I do feel it can get bigger. So it's, if you do have any questions on that, feel free to reach out to myself or Kaylee, and we can actually give you a bit more information there as well.
Absolutely. It's a £40 billion industry in the UK, right? And so there's huge scope. There are bespoke lenders out there that only want to lend against assets, and so 100% worth taking advantage of. Tier 1 facilities, this is your main banks, your NatWest, RBS, Barclays, those guys. They are still lending, despite what it seems a lot of the time. They are still lending. They're being very selective about who they lend to, is the reality of that. And so if you are a business that is doing very well, is in a kind of sector that they like at the moment, then there is lending out there, right? And that they are still supporting businesses. It's restricted because of the amount of money that they've put out over the last 18 months. NatWest alone did basically 5 years worth of lending in a 12-month period. And so they are now naturally a lot more risk averse, and they are being selective about businesses that they support. And it makes sense, right? Because the level of risk that they have out there. But again, something we can still try and facilitate through Raffingers and ourselves. And last but not least, invoice finance. If you thought asset finance was big at a £40 billion industry, invoice finance is an £80 billion industry in the UK. And actually is one of my favourite products, despite the kind of bad reputation it got for itself. Few of you may know invoice finance for its former self, when it was very much lender of last resort, right? Business was really struggling. They didn't want it to go under. It was like, let's go out and plug some invoice finance in and keep them afloat for as long as we can. Actually, that's not the case anymore. It's been through a huge revamp, and invoice finance is now a pretty lucrative product to have, and definitely works for a lot of businesses. Because actually, if you look at something like recovery loan scheme, which worst case is costing you 14.99% a year, and is a fixed amount that you have borrowed over a fixed term, actually an invoice finance facility grows with your business. As your debtor book grows, the invoice finance facility grows with you. And actually at a competitive rate, it can be at 2.5% a year. 2.5% a year for a facility that is growing and potentially releasing capital of up to 90% of your debtor book at any one time, to me is a pretty competitive facility. The issue we see a lot of the time in invoice finance is that clients have either had a bad experience with it before and are kind of put off, or they've got an invoice finance facility that they've had for donkey's years and have never reviewed, because they get a kind of contract out every year that they just sign and renew, right? And so they're actually not aware that there are more tech-enabled platforms to make the process smoother. There are cheaper people out there that can do it for them. There are more old school type firms where they'll still have a dedicated point of contact that manages everything with them. There's a real mix of facilities out there. And actually, we now really have the ability to kind of play matchmaker, right? And take a business and really understand them and their clients and what they're doing, and match them with an invoice finance facility and lender that's really going to be able to support that. So if you are someone that has an invoice finance facility, let's look at it. Let's make sure you've got the kind of best deal for you. And if you're someone that has a relatively large debtor book that potentially is locking up that cash, let's have a conversation about what that looks like, if we can unlock that, and kind of what you would need out of that kind of facility, for sure. Perfect. And that is it from me. Happy to take any questions, or Mehul, if you've got anything you want to add.
No, nothing. So I think it's been very interesting. I imagine for all of you as well who've been listening in. A lot of this stuff, until you get into it and until you understand it, and it's the same for us as well when we're speaking to Capitalise and to Kaylee. You don't necessarily realise the intricacies and the opportunities available out there. And even if you're refinancing or if you're consolidating your debt, it's always worth having that conversation with us and Capitalise. And it's just something that we're seeing more and more of each year when we're speaking to our clients. So like I said, if you've got any questions on the back of this, whether it's the RLS with the recovery loan scheme or any other type of lending, or the super deductions with the tax, like I mentioned, anything else that you feel that you want to find out more about, just feel free to contact us, and we can point you in the right direction, whether it comes to lending through Capitalise and Kaylee, or at the same time we can look to answer your questions with regards to the tax consequences, or going forward in terms of how your business is geared up from a strategy and a business planning point of view with regards to the lending market. So it's always worth having that conversation. We haven't got any questions at the moment, which means it's a good thing, hopefully, Kaylee, that everyone's understood and everyone's really happy with everything that you've discussed. But like I said, guys, if there's anything else, always feel free to reach out to us, and we can do what we can to help. But thank you for attending today, and I hope to catch up with you guys soon.